Hey everybody, welcome to Trading Capital. It is May 24th here, and we're going to do a deep dive on the real estate market and why it is so important for the average consumer to understand what is likely to unfold over the next 6 to 24 months. And one can argue we are already starting to see cracks appear in the real estate market that could eventually turn into much more than cracks in the real estate markets. I am seeing a lot of signals, and based off of math, that we are potentially heading for a massive housing decline. I don't want to say crash, but that is certainly in the cards and a very well possible scenario that could happen. And when we look, jumping right into the Federal Reserve's balance sheet, the Federal Reserve has expanded their balance sheet significantly through direct purchasing of mortgage-backed securities and treasuries. So when you look at the mortgage-backed securities, which is essentially expanded to levels that we have not seen before, the Fed's balance sheet for the weekly data going from January 2008 to May 11th, 2022, so a couple weeks ago, the Fed's balance sheet in terms of mortgage-backed securities topped 2.7 trillion. It was trading in a range of about 1.7 trillion before it dropped down to about 1.3, 1.4 area, and then COVID hit and they just started pumping, buying real estate, mortgage-backed securities, and it hit a ballooned amount of 2.7 trillion. So from the 1.7 trillion to the 2.72 trillion, that's roughly a 54% increase. And I think it's a plus 60% increase from the low here that they've expanded. And you can wonder why the real estate market has been on a tear, especially over the last 2 years. But even when you look over the last 10 years, it's just been a constant expansion. You know, there's been some cyclical times where you've declined and went through tightening periods. But now you've had a ballooned valuation. Properties have skyrocketed. Valuations are steep. Inflation is at an all-time high or a multi-year high. Sorry, I should correct myself, over a 40-year high. You couple all these things into what the current environment and where we're heading, it's a dangerous game out there. So some simple calculations starting on the right side of our screen here. The Federal Reserve's plan starting June 1, so within a week, their plan is to reduce their balance sheet by $35 billion a month in mortgage-backed securities. So let's assume, and by the way, that plan is supposed to ramp up over the course of 3 months. So this is just their conservative starter number, and it's supposed to ramp up in the form of treasuries as well, and potentially going higher in the mortgage-backed securities area as well. And keep in mind, over the 18-month period, they were pumping $120 billion a month for roughly 18 months into the economy, over and above all of the stimulus packages that were released. So when you factor in $120 billion a month, $80 billion were going to treasuries, $40 billion was going to mortgage-backed securities, they're already starting tapering at a lower amount than what they were injecting over the course of 18 months. So if they're very serious about tackling inflation, which I think they have to a certain degree, I don't think they'll ever go back to their baseline numbers. We'll certainly be living with a new high. But if they're serious, this has to ramp up at some point. But let's go with the conservative number of $35 billion, which is what they're starting next month. If you remove $35 billion a month for the course of 12 months, that equates to a $420 billion reduction over the course of 1 year of the Fed's balance sheet. So year one, starting at 2.7 trillion minus 420 billion, that reduces the balance sheet to 2.28 trillion. That equates to an 18.4% reduction in the first year. So it stands to suggest that the real estate market over the first year should decline by a minimum of 18.4% if they stick to this conservative reduction of $35 billion a month. If they plan to have the tightening over a 2-year period and they stick to a 2-year tightening cycle, which I find very difficult for them to be able to do, then, but let's just say they do, if you take the amount from after the year one tightening, which is 2.28 trillion, minus another 420 billion, you're left with a balance sheet of 1.86 trillion. And that just takes you right in line here to your previous highs of your balance sheet. So it's certainly possible that they can do that. Maybe they even speed this tightening process up, and they do ramp up the tightening of their balance sheet over a shorter period of time, which would imply that a harder correction in a shorter duration is likely to occur. But let's just keep it for math for simple purposes and say that they do this over a 2-year process. That would equate to another 22.5% reduction in the balance sheet over the second year. So combining the 2 years, that totals a decline of 41% potential in the real estate market. And for learning purposes, we're going to flip to the IYR, which is a real estate ETF, which does track the housing market to a degree. If you factor in that the IYR is currently down 20% from the highs, that is very much in line with what the reduction is supposed to be for the first year. And you have to remember, markets are always forward-looking. So roughly 5 months ago, we started hearing the Fed was potentially tapering. And then only up until a couple weeks or a couple months ago, they actually penciled that in stone. And we now have their official reduction plan that is set to begin. So this would line up with the math, 18.4% reduction in the first year. And look, basically starting from January to now, which is almost a 6-month period, 5-month period, you've had a 20% decline in the markets. So factoring in the markets are always looking 6 months forward, plus you've already had 5 months under your belt, that almost aligns with the 1-year target that we had for our mathematical reduction equation here. And then if we factor in the second decline here, the 22.5% reduction, that is likely, if they stick to their plan, to transpire over, let me just fix my charts here again, that is likely to transpire over the next 6 to 8 months. So let's assume we have our bounce and then we have another 22% fall. That would roughly take us down, let's just do this, that would roughly take us down all the way to these pivot lows over here, down over here. So that would be a substantial fall in the real estate market. And this is conservative numbers. And this doesn't quantify. The mathematics don't take into account the potential of fear and panic and emotion. This is just hard numbers, basic conservative numbers, in the sense that the numbers don't lie. The tightening has begun. Withdrawing money from the system implies a severe downturn. And the reason I'm discussing this is because markets always attack the most liquid assets first. We've seen stock markets starting to plunge. We've seen the bond market earlier in the year being attacked and destroyed. And now we're seeing cracks in the real estate sector. And certainly houses are starting to slow down in terms of sales and also coming down in valuation. If we factor in the So if we factor in why I believe real estate is going to continue to crack, just simply looking at this 30-year fixed mortgage rate, the average in the United States, this chart essentially to me says it all. And I hope you can get a great understanding as to why I'm so concerned about the real estate, but why I'm so excited for a real estate collapse or decline, because we have not been able to purchase real estate at decent valuations for quite some time. And I do think naturally a falling real estate will solve a great deal of the inflationary aspects that we have in our society, especially when you look at the CPI, the Consumer Price Index, and the percentage of the weight that rent carries or in housing costs carry in the CPI is just an extensive weight. I believe it's up to 30%. So with real estate being potentially the next asset class to fall, it does suggest that inflation will fall if real estate does fall. But this trend line I drew in, this yellow trend line, this is basically the level that the 30-year mortgage rate hit in the year 2008, and that's when the stock market or the GFC housing crisis commenced. So to factor in that, we are now at the levels that caused basically the greatest housing crash known to man, and we're approaching those levels. It's not only scary that we're approaching those levels, but when you factor in the extreme valuations that properties carry now versus 12 to 14 years ago, there's an extensive amount of difference in the amount of debt that people now have to service, as well as you also factor in the commodity prices like lumber, like steel, like oil. Yes, we had a major oil spike in 2008 as well. However, we did not have those crazy lumber spikes, like we did this year in 2020 and 2021. But the fact that we're at the same levels as the GFC housing crisis and the valuations of properties are substantially higher should be a scary thought for the average consumer. And when we do see the real estate market decline, excuse me, and when we do see the real estate market decline, that's certainly also going to put a lot of pressure on equities. There won't be those technical bounces. I do think a declining mortgage or a declining real estate market will coincide with the major bottom in the stock market. And it could be, several months to potentially a year that we form a base. Looking at some more housing data, the United States mortgage applications have significantly decreased. Just looking at the end of April, beginning of May. We're still in May, and look at the decline in mortgage applications. If you were to factor this on a percentage basis from the high there, you have had a over 500% drop in mortgage applications. That is an exceptional drop. And if you look at the periods that we hit the lows, this was your COVID. Here was your start of your hiking cycle in 2015. This is your kind of your housing bubble crash, your lows here. So it just shows once you start reaching the lower threshold of this range, it does not usually signal a good thing. And again, housing starts have had a massive boom over the last, decade and more since the housing crisis. Then you had the COVID low. But we're at that point now where we should see some sort of a pullback in the housing starts as well. And that's kind of what the new leading data is showing, that housing starts are still at record levels. And that's potentially what could cause the real estate market to hit that inflection point. When you have a massive amount of new builds coming on, but slowing demand, that's a recipe for disaster. It's all fine and dandy to keep building and building and building while you still have the demand, but when you're building and the demand slips, that is the notorious turning point in the real estate market that often signifies a top. And we're certainly seeing the housing market slow. When you factor in January of 2021, the 30-year mortgage rate, so let's just flip back to this mortgage rate. The 30-year mortgage rate in January 2021 was roughly sitting at, let's just go back to here, was roughly sitting at 2.65%. And this is for the United States of America. And the average home back then was roughly $401,000. Okay. Today, the 30-year mortgage rate is sitting at, you can see here, 5.25%. And the average home price is $570,000. So assuming most people put a 20% down payment, that's roughly an increase from 1 year ago from your mortgage rate. If you took that same mortgage on that $401,000, you would have roughly been paying $1,300 a month. That same mortgage on today's valuation, property valuations, is now over $2,500. So it's almost doubled the mortgage payment from 1 year ago. And this is why I do think the housing market is in for some dire straits in the near future over the next 6 to 18 months. So the real estate market, generally the physical market, is roughly, it lags the real estate ETFs. The real estate ETFs are generally 6 to 12 months ahead of the physical real estate market. So the fact that we are already down 20%, having a small bounce, but are projected to head much lower, it does mean the physical real estate market is not very far from starting to have these drastic declines. And certain areas are going to hold up a lot better than others, but an overall consensus. When you have a tightening of mortgage-backed securities and rising rates, we have not experienced those tighter monetary policy periods for quite some time. And the reason we have to go through this cleanse, it's just part of the business cycle. It's no hard feelings. But the reason we have to go through this is because inflation is now rearing its ugly head, as opposed to over the last decade, we have not had to really deal with much inflation. And I do think inflation will come down once all of these asset classes fall. And real estate is certainly going to be that final basket that does need to see a really, really hard correction. And for anybody who's looking to purchase real estate, probably the best indicator is going to be if we simply look at the US 10-year. So let's just take a look at that. So the US 10-year is going to be a massive, massive leading indicator. Simply identifying when the US 10-year starts breaking this trend here, this yellow point of support. Once you start breaking that and starting to trade back in this blue parallel channels and starting to taking out key pivot lows, that's going to be your sign that the bottom is near or a crash is potentially on the horizon if the markets haven't declined substantially. So monitoring yields is going to be your best bet, and understanding why interest rates move the way they do will ultimately give you a leg up in the housing market. There's going to be a tremendous opportunities once the housing market does bottom. Just like it happened in 2008, there were tremendous opportunities to go long real estate, and that opportunity will come again, but not before substantial pain is realized. Thank you all for being members and subscribers. Please give a big like on this video or comment below on what you think will transpire in terms of the real estate sector. I hope I can continue to keep providing educational material and help steer people in the right side of the business cycle, because certainly being on the wrong side of this cycle could have detrimental impact on a person's wealth, retirement, savings, you name it, and overall emotional and physical well-being. So please stay vigilant out there and understand what data is important to analyze and stay on top of. Certainly the real estate market, interest rates, money supply, and overall what the Federal Reserve is doing is going to be the key macro data to follow. Thank you, everybody. Enjoy your night.